If no tax on Social Security becomes real, your check might not rise the way you think it will. Some people would see a bump, others would see almost nothing, and a few could get surprised at tax time. The risky part is believing a headline, changing your plan, and then finding out your money didn't change. This hits retirees, disabled beneficiaries, survivors, and anyone helping a parent manage benefits. Want a layer of protection against bad advice and fast-moving rumors? Subscribe so you can stay ahead of changes before they reach your mailbox. This channel is about keeping you informed, calm, and prepared. If policies shift, you'll hear the real-world impact here first. Before we talk numbers, let's make one thing feel steady. You're not behind, and you're not supposed to just know this stuff. The rules are confusing on purpose, and that confusion is where mistakes happen. So I'm going to walk with you step by step, and you'll leave with a clear way to estimate your own outcome. Here's what's at risk if you guess instead of calculate. You could underwithhold taxes, overspend a raise that never arrives, or miss a chance to lower stress in your budget. And if you're on a tight monthly plan, even a small misread can ripple into bills and savings. Stay to the end, because I'll show you the one tiny detail that most people miss when they estimate their increase. Let's define the headline in everyday terms. No tax on Social Security usually means your benefits would stop being counted as taxable income on your return. It does not mean your benefit amount automatically goes up. It means the tax bite on the back end could shrink or disappear, depending on your full income picture. Quick attention reset. Don't let the phrase "no tax" rush you. Taxes are personal because your Social Security interacts with your other income. Two people with the same benefit can have totally different tax outcomes. So the honest question isn't, will checks rise, but will your taxes owed drop? Now, who actually pays federal income tax on Social Security today? Not everyone. Many beneficiaries owe zero federal income tax on their benefits already. If Social Security is your only income, or your other income is small, you may already be in the no tax on benefits zone. That's why some people will celebrate a change that doesn't change their wallet at all. So how would you know which group you're in? You look at your total income situation, not just your benefit. Social Security taxation is triggered by a formula that blends benefits with other income sources. And that leads to the first big clarity. Your increase is really a tax savings estimate. Let's slow down and make the estimate feel tangible. Your benefit check is the gross amount deposited each month. Your tax outcome is what happens across the entire year when you file. If a rule change removes tax on benefits, the gain is the difference between what you would have owed and what you would owe. Another attention reset. This is where scammers show up. If anyone calls, texts, or emails claiming they can unlock your bigger Social Security check, treat it like a trap. Never share verification codes, never click unknown links, and never trust caller ID. If you need to confirm anything, hang up and call back using the official number from your own documents. Now let's talk structure, because policy changes don't happen by vibes. A promise is not a law, and a rumor is not a paycheck. For a change like this, it typically has to move through the normal lawmaking process. That means it can be proposed, debated, changed, delayed, or dropped, and timing is always uncertain. So what can you do right now that actually helps you? You can calculate what your tax on benefits is costing you today. Then you can see what no tax would save you if it happened. That way, you're not reacting emotionally to headlines. You're holding a number in your hand. Here's a simple way to think about it. Your yearly increase would roughly equal your tax rate times the amount of your benefits that are currently being taxed. You don't need perfect precision for a first estimate. You just need a realistic range so you can plan without overpromising to yourself. Are you tracking your real net income after taxes, or are you still planning off the deposit amount alone? Let's do example 1 with easy math, and I'll keep it hypothetical. Imagine Jordan receives $2,000 a month from Social Security, so $24,000 a year. Jordan also pulls $18,000 a year from a small pension, making the tax formula kick in. If Jordan ends up paying, say, $1,800 a year in federal tax tied to the benefits portion, that's $150 a month of hidden cost. If no tax on benefits became real in Jordan's situation, the gain is not a bigger benefit award. The gain is that $1,800 might stay in Jordan's pocket instead of going out at filing time. That could feel like a $150 monthly raise if it's spread across the year. But notice the key. The savings depends on Jordan's other income and tax bracket. Attention reset. Don't copy Jordan's numbers into your life. Copy the method. Annual benefits, other income, estimated tax tied to benefits, then convert to a monthly feel. And if your taxes are withheld from other sources, you might not feel the raise monthly unless you change withholding. That's the kind of nuance that gets missed in viral clips. Now, example 2. Because work income changes the story fast. Imagine Priya gets $1,600 a month in benefits, so $19,200 a year. Priya also works part-time and earns $12,000 a year plus $3,000 a year of interest and dividends. Let's say Priya's benefit taxation and bracket result in about $900 a year of extra federal tax. If the rule changed, Priya might save that $900 for the year. That's about $75 a month in breathing room. Not nothing, but also not the hundreds more per month that people casually promise online. And if Priya is already set up for withholding, the benefit might show up as a bigger refund, not a bigger monthly deposit. Here's the myth versus the truth moment. Myth. If they stop taxing Social Security, everyone's check goes up. Truth. Many people already pay no tax on benefits, so their increase could be zero. And for people who do pay, the gain depends on the rest of their income and how they handle withholding. Let's open the loop again, because this is where your real power is. There's one small detail most people overlook when they estimate the increase. They assume the government will automatically adjust their monthly withholding or payment flow. Later, I'll show you exactly how that detail can turn a raise into a disappointment if you ignore it. Now, let's talk about why you're seeing so much noise about this idea. Taxes on benefits are emotionally charged because you paid in for years and you don't like seeing anything reduced. So it's an easy headline to rally around. But the reality is, a tax change also changes cash flow into the overall program and the broader budget, and that's why it becomes a fight. You do not need to pick a side in a shouting match to protect yourself. You just need to know what would happen to your household. You can be supportive of an idea and still demand details before you budget around it. That's how you stay safe and steady. Attention reset. You're not trying to predict politics. You're building a plan that survives uncertainty. The right mindset is, if it happens, here's what it means for me. If it doesn't, I'm still okay. That's real financial calm. Now let's go step by step through a clean estimate you can do at home. Step 1 is to gather last year's tax return and your Social Security statement form for the year. If you don't have them, request them through official channels, not a random email. You're looking for how much you received and whether any of it was treated as taxable income. Step 2 is to identify your other income sources: work wages, self-employment, pensions, retirement account withdrawals, interest, dividends, and anything else that shows up on your return. You don't need to memorize forms. You just need totals. If you're married, you consider both spouses together for the household return. Step 3 is to look at your total tax paid and your effective tax rate as a rough guide. Again, rough is fine at first. If you paid $2,000 of federal income tax on a taxable income around $40,000, your overall rate is about 5%. That doesn't mean every dollar is taxed the same, but it gives you a starting lens. Step 4 is to estimate how much of your benefits are currently being taxed. Some people are in a zone where none of the benefits are taxed. Some are in a middle zone where a portion is counted as taxable. And some have enough other income that a large portion is counted, even though it's not taxed at 100%. Step 5 is the what-if comparison. If benefits were no longer taxable, how much taxable income would disappear from your return? Then you estimate how much tax that would remove, based on your bracket and your overall situation. This gives you a realistic range rather than a fantasy number. Do you want me to help you build a quick back-of-the-napkin estimate from your numbers, so you stop guessing? Now we move into common mistakes, because this is where people lose money quietly. One mistake is assuming this change would raise your benefit calculation. Benefit amounts are based on your work history and claiming choices, not whether benefits are taxed. So if you plan spending as if your award amount will change, you can set yourself up to overspend. Another mistake is forgetting that state taxes may be different from federal taxes. Some places tax benefits in certain situations, some don't, and rules can change. So even if federal tax changes, your state outcome might not match. Always verify with official state guidance or a qualified tax professional if you're unsure. Another mistake is misunderstanding withholding. Even today, many people don't have taxes withheld from Social Security checks, and they handle taxes later. If a change happens, you might still have withholding turned on from another source like a pension. So the raise may appear as a bigger refund rather than more monthly cash, unless you intentionally adjust. Another mistake is changing retirement account withdrawals too fast. Some people think, great, now I can take more from my retirement account. But those withdrawals can raise your taxable income and affect other costs tied to income. So the net result can be smaller than expected if you chase a bigger withdrawal without checking the ripple effects. Another mistake is trusting unofficial helpers. If anyone claims they can file something to qualify you for the increase, be suspicious. You do not pay a stranger to activate a tax law. Never share your Social Security number, never share one-time passcodes, and never let someone remote into your computer because they promise a benefit boost. Attention reset. None of these mistakes mean you're careless. They mean the system is complicated, and your brain wants a quick answer. That's normal, but we're choosing accuracy over speed, and that choice keeps you in control. Now, if this is you, I want you to recognize yourself in one of these situations. If you live mostly on Social Security and a small amount of extra income, your taxes on benefits might already be zero. In that case, the best move is not excitement, it's confirmation. You verify your current tax situation so you don't waste energy waiting for a change that wouldn't change your outcome. If this is you, you have Social Security plus a pension or steady retirement withdrawals. You are more likely to be in the group that could see real savings if benefits stop being taxed. Your job is to estimate the savings and decide whether to adjust withholding or quarterly payments. That way, the money shows up in your monthly life instead of being trapped in a once-a-year surprise. If this is you, you're helping a parent or spouse, and you're the one juggling bills. Your biggest risk is acting on a headline and changing their budget, their withholding, or their banking setup. Instead, you set a rule. No changes until you see official confirmation and you run the numbers. That's how you protect someone vulnerable from both confusion and scams. Let's return to the open loop, because we're getting close to the payoff. The small detail most people miss is not about politics. It's about timing and cash flow. Even if taxes on benefits were removed, your monthly deposit might not change automatically unless your withholding strategy changes. Here's what I mean, and this matters a lot. Some people pay taxes on benefits by having withholding taken out of a pension, job paycheck, or retirement withdrawal. Others pay by sending estimated payments during the year. Others pay nothing until filing time and then write a check. If the law changed and you didn't update anything, you could end up overpaying during the year. That isn't the end of the world, but it means your increase becomes a refund you wait for. If you need monthly breathing room, you might prefer to adjust withholding so you keep more each month. That's the practical lever most people forget exists. Attention reset. This is not telling you to mess with forms blindly. It's telling you to understand where your taxes are currently leaving your life. Then you can decide what you want, a bigger monthly net or a bigger refund later. Both are valid, but you should choose, not drift. Now let's talk about the emotional trap that shows up next. Once people hear no tax, they start mentally spending money they don't have yet. They upgrade a subscription, promise gifts, or commit to a new car payment. But until a change is official and implemented, that money is imaginary. So here's the calm approach. Treat any potential savings like a pending deposit, not a guaranteed raise. If you want to be proactive, build a what-if budget version and keep it on paper only. Then if the change becomes real, you already know exactly where the money should go. Would it change your stress level if you knew your exact tax on benefits cost down to the month instead of guessing? Now let's discuss what "how much will my check increase" can mean in 3 different ways. It can mean a higher gross benefit amount, which is unlikely from a tax change alone. It can mean a higher net deposit because less is withheld, which depends on your settings. Or it can mean lower taxes owed overall, which might show up as a refund or smaller tax bill. When someone online claims your check will increase by $300, ask them a simple question. Are they talking about the gross benefit amount, or the net after taxes, or a yearly total divided by 12? Because those are not the same thing. That one clarification can save you from a lot of disappointment. Attention reset. Words are slippery. A yearly tax savings can be turned into a monthly number to sound bigger and more certain than it is. A refund can be described like a raise. You're not being cynical by questioning it. You're being smart. Now let's address a concern you might have in the background. If benefits stop being taxed, some people worry it could affect the program's long-term funding. You don't need to debate that in the comments to make good personal decisions. But you should understand that big changes often come with trade-offs and may be phased, adjusted, or paired with other changes. That's why your best move is to plan for your household first. If a change happens, you capture the savings responsibly. If it doesn't, you don't get knocked off balance. And if scammers try to exploit the noise, you already have your guardrails up. Now let's pay off the open loop fully with a clear action. The small detail most people miss is this. Your raise is not automatic unless your payment and withholding behavior matches the new reality. So the winning strategy is to map your current tax outflow and decide how you want the benefit to appear. That's what turns policy into real monthly relief. Attention reset. We're going to make this actionable today. No waiting for rumors to settle. No doom scrolling. Just a mini checklist you can do in one sitting. Do this today by grabbing last year's return and circling your total income, your total tax, and whether benefits were taxed. Do this today by writing down your monthly Social Security amount and multiplying by 12 so you see the annual picture. Do this today by listing every other income source you have, even if it feels small. Do this today by noting where taxes are currently being withheld from, if anywhere, so you know where the raise would actually show up. Do this today by choosing one safe verification step. If you use a calculator or official guidance, access it directly through official channels you already trust. Do not click a link from a comment, a text message, or an email that pressures you. And if you need help, talk to a qualified tax professional or a trusted community resource, not a stranger promising guaranteed increases. Do you know exactly which income source in your household is currently doing the withholding work, or is it happening invisibly in the background? Now let's recap what you should remember when someone asks, how much will my check increase? A tax change affects taxes, not your underlying benefit formula. Many people already pay no federal income tax on benefits, so their increase could be zero. For those who do pay, the realistic gain is the tax savings, which can be estimated from your own prior year. We also covered the core misunderstanding that spreads fastest. A yearly savings divided by 12 is not the same as a guaranteed monthly deposit increase, and a refund is not the same as a raise, even if it feels good when it arrives. Your job is to translate headlines into your household math. We walked through 2 examples to show how different lives get different results. One person with a pension saw a meaningful potential savings. Another person with part-time work saw a smaller savings that could still matter. Neither one could assume a number without looking at the full income picture. We also flagged the common mistakes that cost people money. Assuming benefits rise automatically, ignoring state rules, forgetting withholding, changing withdrawals too fast, and trusting unofficial helpers. None of those are moral failures. They're predictable traps, and once you see them, you can avoid them. Attention reset. You now have the advantage. Most people are still stuck at the headline level. You're operating at the what would it do to my actual household level. That's how you stay safe and stay steady. Now for the close, I want to give you one final warning and one hopeful truth. The warning is this. If you treat rumors as income, you can accidentally build a budget on sand. The hopeful truth is that you don't need certainty to have control. You just need a method and a plan. If a change happens, you'll be ready to capture it responsibly, and if it doesn't, you'll still be okay. So here's my final question for you. Do you want your next move to be based on a headline or on a number you calculated for your own life?